Welcome back to the deep dive. You know how we do it here. We take that huge stack of financial reports, dense articles, all that stuff.
Oh, it's jargon.
We strip out the jargon, and we give you what you actually need to know to be, well, seriously informed.
Right.
And today, we're diving into something really foundational, the absolute bedrock of your financial life, where you actually choose to keep your money.
That's right. And we've got two parallel stories today. It's about structure and it's about performance.
Okay.
So the first story is a big one. It's a structural showdown. We're talking about the core philosophical difference between a credit union, the cooperative model, and a traditional for-profit bank.
And we want to see if that nonprofit status actually means better value, like for real.
Exactly. Does it really translate to your wallet? And then the second story is a deep dive into a high performer, a community bank called Potomac Bank Shares.
Formerly BCT, for those who might know them by that name.
Right, formerly BCT. And we're going to use their Q1 2025 earnings report to see the moves they made that led to this just massive spike in their net income.
Okay, so our sources are pretty broad today. We've got earnings reports, corporate news.
And some really deep comparison analyses that put actual numbers on the board for the bank versus credit union debate.
Okay, let's unpack this, starting with a structural showdown. For-profit versus cooperative.
You have to start with identity. It's the only way this makes sense. A bank is, well, it's a machine.
A machine for what?
For profit. It's a corporation, and it's controlled by external stockholders. Its entire reason for being is to generate the highest possible returns for them.
Right, through dividends or just making the stock worth more.
Exactly. But when you look at a credit union, a CU, it's just built on totally different DNA.
It's a cooperative.
A cooperative. That's the key. They're not for profit. They exist only to serve their members. And crucially, the members are also the owners.
And that's not just, marketing speak. That changes how the whole thing is run.
It changes everything. Look at the governance. In a CU, it's one member, one vote. Doesn't matter if you have $50 in your account or 50,000. And the boards, they're usually unpaid volunteers. Your neighbors basically elected by the members.
Which is so different from a bank where voting power is all about how many shares you own and the board members are definitely compensated.
Of course. So that's structural difference. No external shareholders to feed. That's theoretically where all the consumer benefits come from. The money they make has to cycle back to the members.
And that shows up as, what, lower fees, better rates?
Precisely. The tangible benefits really fall into those two buckets.
Yeah.
And when you look at the comparison analyses we sourced, the differences are, you can quantify them.
This is where the data gets really interesting. We pulled a specific example on lending costs.
The auto loan.
The auto loan, yeah. So if you take out a typical $30,000 auto loan for, say, 72 months, the sources showed that a credit union like Lafayette Federal could offer rates so much better than the national average that you, the member, could save up to $1,177 in interest.
Over the life of the loan? That's not small. That's real money back in your pocket.
It's significant. And it's not just on the loan side, right? It flows into savings, too.
It does. Their nonprofit structure means they can be way more aggressive with deposit rates.
Yeah.
We saw that their share certificate rates could be up to 110% higher in APY than what banks were offering on average.
Wow.
You see it credit cards, too. An example APR we saw was 12.90% versus a national average of almost 15%. It's a clear mathematical advantage.
Okay, but we have to talk about the elephant in the room that, kind of fuels this advantage. Taxes.
That's absolutely critical context. Cs get a federal tax exemption. Congress basically gives them a thumbs up for their nonprofit cooperative status.
So they don't pay that big federal corporate income tax bill.
Right. Now, they still pay local taxes, payroll, property, sales, all that.
Yeah.
But they skip the federal one. Banks, being for-profit, pay it.
Although some of them have found ways to reduce that burden.
Oh, for sure. About 29% of community banks use something called a Subchapter S tax structure, which, it's complicated, but it lets profits pass through to the owner's personal tax returns. So it shows banks are also trying to optimize.
So if the benefits are so clear, lower loan costs, higher savings rates, a member focus, why isn't everybody at a credit union? Why are banks still so dominant?
Scale. Reach, and probably just historical inertia.
People just go where their parents went?
Kind of, but mostly it's scale. Banks command a size that credit unions just. They don't even come close. All the credit union assets in the U.S. add up to about $1.03 trillion.
That sounds like a lot of money.
It is. Until you hear the next number. The total asset base for all banks is $14.45 trillion.
Wow.
Oh,
Okay, that is a huge contrast.
it's massive. In fact, just look at the biggest bank, JP Morgan Chase. Their assets alone, almost $1.9 trillion, are more than every single credit union in the U.S. combined.
So the whole CU market share is tiny.
It's about 6.7%. Banks just have the scale, the ubiquity, and often, more complex services that smaller CUs just can't match.
And that distinction scale versus relationship, profit versus cooperative, is what makes our next case study so interesting.
Right.
We're shifting from the cooperative model to Potomac Bank shares, a community bank that's winning because it focuses on relationships while being laser-focused on profit.
Absolutely. Potomac Bankshares is a prime example of a thriving community bank. They're sitting just under that critical billion-dollar asset mark, about $962 million as of late last year. They are just dominating their local market.
And you can see the proof of that both internally and externally. The sources mentioned they were named a best bank to work for by American Banker 5 of the last 6 years.
And that's a huge cultural indicator.
It is, right. A happy team usually means better service.
It's the ultimate sign of a healthy internal culture. If your people are happy, they stick around, and that continuity is everything for a community bank's client relationships.
And it's not just internal, they get external awards too. Top 200 Community Bank in 2023, and they're always winning these local best of the best polls.
For everything from financial planning to loan service, they are just deeply, deeply woven into that local fabric.
So what does a bank like this actually offer? It can't just be checking and savings?
No, it's very targeted. They focus heavily on personalized residential lending. They even have mobile app tools so you can model refinancing savings or check affordability on your phone.
Which is pretty advanced for a community bank.
It is. And they're also a small business administration, an SBA preferred lender.
And for anyone who doesn't know, being an SBA preferred lender is a big deal. It means they can get those government-backed loans processed way faster for small businesses.
Exactly. And because of where they are near D.C., they've also carved out this niche in what they call GovCon banking.
For government contractors.
Yeah, who have very, very unique financial needs. But the real anchor, their historical connection to the community, is their trust and wealth division.
70 years of history there.
A 70-year history. We're talking complex financial and generational planning, portfolio management, and, the really sensitive stuff like estate settlement. That longevity builds an incredible amount of trust.
Okay, let's get to the numbers. This is where their strategy really comes to life. The Q1 2025 earnings report had a headline that definitely made us look twice.
Oh, the headline was pure drama for investors.
Yeah.
Net income shot up to $2.2 million for the first quarter.
Which is up from what?
Up from $1.7 million in Q1 of the previous year. That's a 30% increase.
A 30% jump. That doesn't happen by accident.
No, it's the result of some very precise strategic moves.
And the biggest move, from what we read, actually involved them taking a short-term loss to set up a long-term gain, this yield hunt.
That's the key piece of the puzzle. Late last year, in Q4, the bank deliberately sold off some lower-yielding securities. They took a net loss of almost $400,000.
Which sounds bad on the surface.
Right, but think of it like a store clearing out old inventory to make room for the hot new products. They were repositioning that cash into securities that promised higher yields.
And it paid off fast.
Immediately. It was a perfect optimization play. By Q1, the yield on their total earning assets had climbed to 5.21%. That sounds like a small jump, but on hundreds of millions in assets, that little increase means hundreds of thousands in new sustainable income.
So that's the investment side. What about their core business, the spread between loans and deposits? The net interest margin, the NM?
The NM is the bank's lifeblood. It's their ultimate profit indicator. And Potomac saw a really strong improvement. It jumped 14 basis points to 3.51%.
That's a sign of really disciplined pricing.
Extremely disciplined. They're controlling what they pay depositors for their money while getting maximum income on their new loans.
And they were bringing in a lot of new funds. Loan balances grew at, what, a 7% annualized rate?
And deposits grew even faster at a 10% annualized rate. And here's a critical detail within that.
What's
a lot of that growth was in non-interest-bearing demand deposits.
So checking accounts, money they don't have to pay interest on.
Exactly. That is the cheapest possible funding for a bank. And growing that is a huge boost to their NI and overall profitability.
And you can see that health translates directly to the value of the bank itself. their tangible book value per share went up.
It did, up 14% on an annualized basis
Yeah.
to $18.35. And for anyone listening, think of tangible book value as like the bank's liquidation value.
What you'd get if you sold off all the real assets.
Right. And seeing that number go up means the bank is creating real, measurable wealth for its owners.
And they did all this while getting more efficient.
They're running a very tight ship. Their non-interest expenses, salaries, rent, things like that, actually went down a little from the quarter before. That helped push their efficiency ratio down to a very respectable 67.47%.
And with the efficiency ratio, lower is better.
Lower is always better. It means they're spending less to make each dollar of revenue. It's a sign of just real operational fitness.
Okay, so you have aggressive growth, a high anime, cost cuts. The next question is always the same. Is it safe growth? Are they sacrificing quality for volume?
That's the critical safety check. And the sources here are pretty reassuring. Their asset quality was extremely stable.
What does that mean in numbers?
It means their non-performing assets, the loans that are starting to look a little shaky, were incredibly low. They actually dropped slightly to just 0.25% of their total assets. That is a green light for stability.
And actual losses, the loans they had to write off.
Almost nothing. Negligible. Net charge-offs were just $1,000 for the entire quarter.
$1,000 on a nearly billion-dollar bank.
$1,000. Their allowance for credit losses is stable at 1% of total loans. In fact, they actually added another $250,000 to their provision for credit losses in Q1.
So they're putting more money aside for potential losses, even though they have almost zero actual losses.
Which is exactly what you want to see. It's cautious risk management. They're basically building up their rainy day fund because of all the new loan growth and, just being cautious about the general economic conditions. They trust their own team, but they're keeping an eye on the wider world.
And that confidence shows up in their physical strategy, too. The new loan production office in Ashburn, Virginia.
That's more than just a new office. It's a strategic move into Loudoun County, which is a really high-growth market. It signals they're building capacity to keep this growth going.
And finally, let's talk about the reward for the owners, the shareholders.
A cash dividend, $1.12 per share in Q1.
Which is a big jump from the year before.
A 20% increase. And that jump is the ultimate validation of everything we just talked about. The yield hunting, the IM improvement, the efficiency. The successful strategy benefits everyone.
So stepping back, we've looked at two totally different blueprints, and both are working. On one side, you have the cooperative model, delivering quantifiable member savings, lower rates, higher APYs.
And on the other, you have the rigorous, profit-focused growth of a bank like Potomac Bank shares, driving value through operational excellence while keeping those deep community ties.
What's so fascinating is that no matter which model you are, you still have to do the same core things right. You have to optimize your portfolio, you have to maximize your net interest margin, you have to control expenses.
That operational fitness is just non-negotiable.
Yeah.
The only real difference, the philosophical split, is where you direct the rewards of that success.
Right. Back to the members or out to the shareholders.
Exactly.
So what does this all mean for you? Next time you look at where you keep your money, just remember that the institution's structure, its DNA, that dictates its priorities. Are you looking for maximum savings and minimum fees, like in the CU model? Or do you want that mix of community focus and shareholder value creation? It's a much deeper choice than just who has the closest ATM.
And think about the ambition. We saw the bank that's nearing $1 billion in assets, moving into a new market specifically to create capacity for growth. They're not standing still.
And that brings us to the final thought. Potomac Bank shares trades on the over-the-counter market right now. But a bank with this kind of momentum, strong income growth, physical expansion, a rising book value, they're going to face a big decision. How long before management decides to uplist to a major exchange like the NASDAQ to really capitalize on that growth? That move would change everything for them. Keep an eye on that ticker, PTBS.